We will discuss mortgage rates and cover what are the 7 ways to lower your mortgage rate by 1% or more.
Also, we're going to go over the non-financial benefits of home ownership versus renting. We're going to talk about consumer housing sentiment, what's going on with inventory, listings, price reductions. This is the Max One Market Update. My name's Alan Richardson. I'm with the Max One team.
My name's Ming Richardson, also partner with Max One Team.
Yeah. And so we want to start right off talking about what's happening with mortgage rates. And so mortgage rates are they're moving down. And so we're going on like 4 or 5 weeks now where we've seen nice, consistent drops in the mortgage rates. The markets are starting to kind of, settle down a little bit, that kind of thing, which we're really glad to see. The Fed's going to be meeting. It's an expectation that they'll drop the federal funds
We're
rate.
hoping.
And so, we are seeing mortgage rates move in what we consider to be the right way. But even so, kind of regardless of what the mortgage rates really are, there's
what is the impact of 1% difference on your monthly mortgage payment?
Well, I mean, we're going to go over the 7 ways that we're going to go that you can look at that. But like Ming said, we got to understand that 1% makes a significant, like if you can lower your interest rate by 1%, like what does that do? On average, it equates almost to a 10% savings in your monthly mortgage payment. And so like if you buy a $400,000 house and you make a down payment of 20%, well, there you go. The difference between a 7% rate and a 6% rate
is a saving of $210 a month. That's quite significant.
I mean, that equates to almost $75,000 over the length of a loan. I mean, like, we're talking serious money here when you're talking about 75 grand in there, right?
Yes.
So all that being said, how can you lower your interest rate by 1%? And so we want to kind of cover the 7 ways that, the 7 legal ways that you can do it.
First of all, you can buy mortgage rates down, buy the points down, and you can actually ask this from the seller.
Well, I was going to say, so who can buy the mortgage rate down? Can the buyer buy it down?
Buyer can buy up to a certain point, but the seller can buy it unlimited.
So the seller can buy it. The buyer. What about closing costs? Could that be used to buy down points?
The closing cost is not part of your buy down rate, so therefore that's a 2 separate category you can ask for.
Gotcha. All right. The second way that you can lower your mortgage rate is to improve your credit score. See, that's one thing that a lot of folks like. Okay, if you just have enough to get by, if you have the minimum,
you're at 620,
if you're, for example, or even a 580, because some lenders can get it done at 580. It's pretty tight,
but your interest rate
it's going to eat you alive. It's going to cost you that 1% right there.
Right.
Whereas if you have a great credit score, it's much easier to get. You're going to get better rates on that because you're a less risky borrower.
Correct.
So improving your credit score, paying your bills on time, managing your credit, such an important piece for doing that.
The third way is to increase your down payment.
Yeah, because the bigger the down payment that you're making, the less your principal is going to be. And so
that's less interest in the overall 30-year lifespan of the loan.
Well, and not only that, you're making a smaller risk for the lender. And so like especially a lot of our baby boomer sellers, they're going to turn around and buy, and they may be putting forth 50% of the equity on from their former home. They may only be getting a loan for half of what the home is actually worth. As a lender, that's a much less risky loan, right? It's got 50% equity built in
the game.
And so a lot of times you'll see where you can get better rates because of that.
Not only that, you're not paying a monthly mortgage insurance once you pass the 20% mark.
Now, the fourth one we are going to talk about it, but we're, I don't know, leery is the right word for it.
We are a little leery because, for folks who are only here in Atlanta for less than 5 years, but wants a steady payment every month, ARM rate, adjustable interest rate, is not a bad thing.
I mean, you can get adjustable rate mortgage. Adjustable rate mortgages are running from a point to a point and a half less right now. However, you got to be really solid in your reason for doing an adjustable rate mortgage, because at some point that is going to get triggered and then your payments are going to go up. You may have a lock for a year, 2 years, 5 years, that kind of stuff. But at
normally
some point,
it does not go more than 5 years.
Yeah, but
3 is the average.
But I mean, you're going to see where there are certain instances where an adjustable rate mortgage may make sense for your particular situation.
Correct.
Talk to your lender. We, one of the things that we saw a lot of things, from the 2007, 2008 real estate market crash. A lot of people had adjustable rate mortgages, and when the market recorrected, those people got burned real bad.
Correct.
And so we just want to be. It is there. It's an option. Please go in it eyes wide open and really know what you're talking about.
Basically, do your due diligence, make sure that's a right fit for you. Yep. Okay?
Yep.
So number 5th one is negotiate your mortgage rate. Just because you've been pre-approved by one lender doesn't mean you can shop around with another.
Exactly. Shopping around is so smart.
Certain lender may have incentives or internal grant that you may not be aware of. So this is the benefit of shopping around. When they have those grant for you, guess what? That's less money you got to bring. And maybe you can take that grant money and apply toward your discount point on rates. Well, so and these are things that you can work it out.
One of the aspects here may be maybe you are going to look at new construction instead. Because right now, a lot of our new construction builders, we've got some that are offering a 4.5% rate, a 5% rate right now, depending on certain homes.
Correct.
And so
they're mostly likely existing inventory.
Yeah, exactly. The 6th way that you're going to be able to lower your interest rate by 1% is if you will opt for a shorter home loan term.
Meaning a 15-year loan versus 30 years. So while it may be a much bigger lump sum payment, at the end of the day, think about it. You're paying
a lot less interest. You are absolutely.
And your interest on those money are a lot less.
Yeah. And then the last thing here is that, we started by talking about buying down mortgage rates. Mm-hmm. But where we really want to go here on this one and just kind of wrap it up is, what if it's just a temporary buy down? You can do that. A lot of our builders are doing that. Some sellers are doing that. And so you can buy it for the first year. It's going to be, say, 2% less than market rate. Then it's going to be next year, it's going to be 1% less. Third year, it's going to go to
the regular rates.
Right.
So they're betting on they're hedging on is that in 2 years' time, at some point during that window, the interest rate's going to go down and they'll refinance to a permanent rate.
Yeah. All right. Well, let's change gears out of renting. I mean, out of mortgages and talk about homeowners kind of thing. And so there's a recent study done out there by Redfin, and they were like, hey, what sense of belonging do you have in your neighborhood, in your community? And what they found is that younger homeowners feel the most connected, and younger renters feel the least connected. And that is such an important piece in our market, because on one hand, we understand that owning real estate is the number one path to wealth in the United States, right? And so it's definitely, as long as you're going to live in a home for a certain amount of time, that kind of stuff, it's a really sound investment where a lot of Americans build a lot of their wealth that way. And that's very, very true. In addition to that, there's a lot of other benefits of home ownership that sometimes just get missed out. I remember back it's been a long time ago since we were renters. But when we were renters and you're renting an apartment and there's somebody stomping on the floor up above your head and beeping cars and banging stairs, and
inconvenience, the parking, and there's really, even though you're inside your four wall, it doesn't feel like there's a true privacy.
Half the time you're sharing a wall with somebody else. So understand that there's a lot of other benefits out there besides just growing in wealth. Being able to interact with your neighbors, and that's why for our buyers today. It used to be we didn't work. I mean, at least we didn't see a lot of our buyers paying as close attention as they are now to their neighborhoods. Neighborhood matters so much because a lot of people work from home.
Community.
It is your sense of community. That's the water cooler for a lot of people now, that kind of stuff. Having that sense of being connected, belonging inside the neighborhood is so important right now. And so our homeowners have such a greater sense. So
for the millennial Gen Z, the one that actually own their property right now, they feel like about 68% feel like this is their community.
Have a sense of belonging.
Right. They belong there. While about 44% of that same group says that's
who are
renting.
Renters.
There's like, this is not
my, it doesn't feel like home.
Right.
Yeah, exactly. And see, part of the reason why we're trying to talk about this, especially for our younger buyers right now, is because this past year, first time buyer home ownership hit an all-time low.
We have never had this low of first-time home buyer.
24% of buyers, only 24% of buyers are first-time buyers, and that's the lowest. At one point, gosh, I mean, probably in 2008, 9 kind of thing, even 2004, over 50% of our buyers were first-time buyers.
And so, the funny thing is that, we currently have the largest population first-time home buyer, meaning the millennial and Gen Z, combined outdo baby boomers. So for us to have that large concentration of that generation that is really willing to and open to buy, the fact is that they're unable to buy. That is an issue with affordability, and it's a little discouraging. But come talk to us, because we'll be more than happy to show you how to go about either saving up to where you can buy it, or show you how to do certain thing to benefit you.
Yeah, just because I guess just building on what Ming was saying here is that, we want you to buck the trend and understand